Can you actually live off dividends? The internet says yes. The math says maybe. The reality, it's completely possible, but only if you stop chasing yield and start building income architecture. Most people look at a 4% or 5% dividend yield, do a quick calculation, and think they're set. Then they realize they're leaving out taxes, inflation, and the fact that stock prices don't move in straight lines. Today, I'm breaking down exactly how to turn dividend growth into a reliable paycheck replacement. No hype, no shortcuts, just the step-by-step blueprint that actually works. Let's strip away the jargon. A dividend isn't a bonus, it's a distribution of cash flow. When you buy a share of a dividend-paying company, you're buying a fractional ownership stake in a business that generates real profits. Instead of reinvesting every dollar back into expansion, the board decides to send a portion of those profits directly to you. That's your dividend. Think of it like owning a small slice of a rental property that pays you monthly rent. Except you don't deal with tenants, plumbing, or property taxes. Now, here's the part most beginners miss. Dividends grow. Companies that raise their payouts year after year aren't just handing out cash. They're signaling consistent earnings growth, pricing power, and disciplined capital allocation. That's why dividend growth investing isn't about finding the highest number on a screen. It's about buying businesses that increase your income while you sleep. So, how much do you actually need to quit relying on a paycheck? Start with your annual expenses. Let's say you need $60,000 a year to cover housing, food, healthcare, and the occasional splurge. If you're targeting a sustainable 4% portfolio yield, the math is straightforward. $60,000 divided by 0.04 equals $1.5 million. That's your baseline. But here's where reality kicks in. Inflation. At 2 to 3% annual inflation, your $60,000 today will need to become $61,800 next year. Then $63,600 the year after. A static portfolio won't keep up. That's why you don't just need dividends, you need growing dividends. Companies that consistently raise payouts act as a natural inflation hedge. Your income climbs alongside your cost of living, without you having to touch your principal. This is your freedom number, not a random six-figure goal. A precise, inflation-adjusted target based on your actual spending, not a fantasy budget. Reaching that number doesn't happen by picking random high-yield stocks. It's built on 3 non-negotiable pillars. First, quality over yield. A 10% dividend sounds amazing until it gets cut. Sustainable dividends come from companies with strong balance sheets, consistent free cash flow, and reasonable payout ratios. If a company is paying out more than it earns, that yield is a trap, not a reward. Second, diversification by cash flow source. Don't cluster your income in one sector. Utilities behave differently than consumer staples, which behave differently than healthcare or industrials. When one sector cycles down, others can hold your income steady. ETFs focused on dividend growth, or a carefully curated list of individual stocks across sectors, solve this efficiently. Third, the reinvestment phase. In the early years, you're not living off dividends. You're compounding them. Every payout buys more shares. More shares mean larger payouts next quarter. This isn't just math, it's behavioral. The discipline to reinvest instead of cash out early is what separates hobby investors from those who actually replace their income. Now, how do you speed this up without taking reckless risks? 3 tactical moves. 1. Use dividend reinvestment plans automatically. Most brokerages let you toggle DRIP on with one click. It removes emotion and forces compounding to work in the background. 2. Dollar cost average. Instead of waiting for the perfect time to deploy a lump sum, invest a fixed amount monthly. You buy more shares when prices dip, fewer when they spike, and your average cost smooths out over time. It's boring. It works. 3. Account placement matters. Dividends in a taxable account can drag your returns if they're taxed as ordinary income. Holding dividend growth assets in a Roth IRA or similar tax-advantaged account lets that compounding happen completely tax-free. That single decision can add tens of thousands to your long-term income stream. Let's be honest, you won't replace your salary in 6 months. Dividend growth investing is a marathon with a clear finish line. You'll experience market drops. You'll see headlines calling dividends dead. You'll be tempted to chase yield during bull markets. Ignore it. Stick to your quality filters. Keep reinvesting. Let time do the heavy lifting. When your portfolio finally crosses your freedom number, you won't feel like you beat the market. You'll feel something much better. Predictable cash flow that covers your life on your terms. If you want a step-by-step breakdown of how to screen for dividend growers, set up automatic reinvestment, and structure your accounts for maximum compounding, tap the video on screen right now. Drop your current dividend target in the comments. I'll reply with a custom yield-to-expense ratio. And if you're serious about building income that outlasts market cycles, hit subscribe. Your future self is already thanking you.